Okay, let's jump right into this explainer and unravel a pretty massive mystery happening deep within the plumbing of the global financial system right now. When we think about financial markets, we usually picture ticker tapes, high-frequency trading, or maybe the latest tech earnings. But today, we're popping the hood. We're looking at the hidden infrastructure that literally keeps the multi-trillion-dollar derivatives market from collapsing. It is an amazing story about risk, big data, and a fundamental evolution in how global clearinghouses actually protect the economy from total catastrophe.
Section 1. The Long-Short Margin Mystery. Let's set the stage. Imagine you're trading futures. You decide to take a position, and the exchange asks for a deposit, your margin, just to make sure you can cover any potential losses. Pretty standard, right? Well, recently, traders have started noticing something that totally defies traditional trading logic.
Here's the wild part. Taking a short position on the exact same contract can suddenly cost you 20% more in margin than going long. Seriously, think about that for a second. We're talking about the exact same asset, the exact same contract size, and the exact same current market price. Yet, simply flipping your bet from I think it'll go up to I think it'll go down suddenly triggers this massive premium in the collateral you have to put up.
So looking at that glaring discrepancy, you really have to ask yourself, is the market just broken right now? Or is there a fundamental shift happening in how global clearinghouses view risk? Well, I can tell you right off the bat, this is absolutely not a glitch. It's not the market malfunctioning. What we're actually witnessing is a quiet but completely radical revolution in market infrastructure. The financial world has essentially admitted a hard truth. Risk is not fixed, liquidity is definitely never free, and the danger of a market moving up versus crashing down is almost never symmetrical.
Moving on to Section 2, Farewell to Traditional SBN. To really grasp this shift, we need to take a quick look at the old guard of risk management to see exactly what's being replaced.
For decades, the entire global futures market relied on this one legendary framework called SPAN, that stands for Standard Portfolio Analysis of Risk. It was introduced by the Chicago Mercantile Exchange way back in 1988. Now, it wasn't primitive by any means. For its time, it was actually super advanced, featuring built-in volatility scans and intermonth spread modules to make sure margins were covered. But here's the catch. Its core logic was entirely rule-based. It simulated potential risks through a set of predefined extreme scenarios. And because it relied on those scenarios, it needed constant manual calibrations by human risk managers tweaking the dials.
And that brings us to the ultimate breaking point. Remember the historic April 2020 WTI crude oil crash? Prices hit negative $37 a barrel. Negative 37! It was a moment that absolutely shocked the world. Oil literally became less than worthless. Producers were out there paying people just to take it off their hands.
Now, clearinghouses miraculously survived that crisis without major defaults, which is incredible. But that extreme regime shift proved beyond a doubt that human-calibrated scan ranges just couldn't keep up when liquidity instantly evaporated. I mean, when the market goes entirely nonlinear and trading dries up in seconds, the old system forced clearinghouses to rely on massive human intervention, urgently manually adjusting parameters just to reflect the sheer chaos. The legacy system was simply too slow for modern hyper-volatile shocks.
So that leads us right into Section 3, Shift to HVaR data model. Those limitations were the catalyst, but the real driving force for change came from the very top.
This whole transition was actually initially triggered by the 2008 Lehman Brothers collapse, which led to incredibly strict regulatory standards, specifically the PFMI, or Principles for Financial Market Infrastructures. Under these new rules, clearinghouses were basically ordered to adopt way stricter capital coverage and anti-procyclicality measures. So giants like CME and ICE are now gradually abandoning those old rule-based frameworks. What are they moving to? Data-driven historical value at risk, or HVaR models. It's a massive shift from asking humans to guess the worst-case scenario to letting massive oceans of historical data calculate the exact mathematical risk.
But here's the crucial point. They didn't just flip a switch overnight. This is a highly methodical evolution using full market cycles of historical data to price risk. For example, CME's SPAN 2 took a very steady transition strategy, rolling out first with energy products before expanding. ICE is doing something similar, moving at its own pace with its IRM2 system. It's a gradual rollout, but make no mistake, the trend is completely undeniable. Pricing risk based on massive historical data cycles is for sure the irreversible future of the market.
Section 4. Asymmetric tail risk. Okay, let's tie this all back to our initial mystery. Why that 20% margin difference between going long and going short? How does this new data-driven system mathematically justify charging a short seller so much more?
The answer lies in a concept known as return distribution skewness. It sounds complicated, but it's really just the mathematical realization that the danger of a market exploding upwards is a totally different beast than it crashing downwards. The historical data proves it. Tail risk, which is just the probability of really extreme, rare events, is almost never identical on both sides of the price spectrum.
To put that into perspective, just think about the 2022 European energy crisis. Natural gas prices violently surged upwards. Geopolitical supply shocks showed us perfectly that the momentum of an upward price explosion can be so much more destructive than a downward crash. So, in assets with this kind of skewed profile, the historical value at risk for a long position versus a short position splits drastically. The data plainly showed that short sellers faced vastly more catastrophic risk than long buyers.
And there's another layer to this. Clearinghouses now slap massive liquidity add-ons right onto those shorts. They are directly charging traders upfront for the potential market shock their forced liquidation would cause. Think about it. If a trader holding a massive short position defaults, the clearinghouse has to step in and forcefully buy back that position. In a market where liquidity has already completely dried up, that massive forced buying is going to aggressively drive the price up even further, creating this terrifying feedback loop. The system now takes that potential liquidity drain and converts it straight into a capital cost. And boom, that is exactly why your short margin is suddenly 20% higher.
Section 5. Pro-cyclicality and safety nets. Now, as brilliant as this shiny new HVaR model is, it actually comes with a really dangerous side effect. Because it turns out, when you base your entire risk model purely on reactive historical data, you can accidentally create a total monster during a crisis.
It's known as the procyclical trap. It's this incredibly ironic paradox where the system demands massive piles of cash from traders right in the dead center of a crisis, which accidentally amplifies the market panic. Here's how it plays out. When the market is nice and calm, the data tells the system, hey, lower the margin requirements. So traders take on more leverage. But the exact second a crisis hits and volatility spikes, the HVaR model instantly demands massive margin calls. Right when traders are at their absolute most vulnerable, the system drains their capital, forcing them to fire sell assets just to raise cash. And what does that do? It ironically drives prices down further and creates even more panic.
So, to stop this vicious cycle in its tracks, clearinghouses are mandated by regulators to deploy a strict three-part safety net. First up, they artificially extend the historical look-back period, sometimes forcing the model to chew on 5 to 10 years of data. That ensures it includes past stress events, smoothing out short-term volatility jumps. Second, they set hard margin floors, basically making sure requirements never drop too low even during the quietest times. And third, they tack on extreme stress risk buffers. Only with all these anti-pro-cyclicality measures locked in place can the HVaR model safely do its highly sensitive risk calculations without accidentally breaking the market during a panic.
Which brings us to our final part, Section 6, the true price of protection. As we wrap up this explainer, we really need to step back and understand what this all means for the broader market ecosystem. To your average trader, margin is just an annoying cost of doing business. But to a global clearinghouse, margin is the absolute last line of capital defense, shielding the entire financial system from total collapse.
Margin is no longer just some static deposit sitting in an account. It has completely evolved into a dynamic, real-time warning system, tracking the cost of liquidity and asymmetric tail risk in a multi-trillion-dollar arena. Just think about how much the industry has shifted. 20 years ago, the main challenge was just matching trades quickly. 10 years ago, the big arms race was about cutting latency down to the microsecond. But today, the core mission is managing extreme risk. This transition from SPAN to HVaR is not just a software update. It's the story of how past financial crises have literally forced global infrastructure to become this incredibly sophisticated, data-driven, heavily regulated machine.
And that leaves us with one final lingering thought. With all these incredibly advanced, data-driven safeguards, the margin floors, the liquidity add-ons, all of it now firmly in place, is the global financial plumbing truly prepared for the next unthinkable shock? We've built an absolutely brilliant shield, but it's based on the data of the past. The ultimate test will be the black swan of the future. Thank you so much for joining me on this explainer, and I'll catch you next time as we continue to decode the hidden systems running our world.